Hello and welcome back. Today, let's go through superannuation contributions, what they are, the different types, and how they can help grow your retirement savings. I'll also explain the tax benefits in a really simple way so you can see why making contributions into super can be such a smart strategy. My name is Melanie Davies. I'm a licensed independent financial advisor. You can find more out about me on the Financial Advisors Register, linked in the description box below. It's important to know that all of my content is general in nature and is considered general advice only. That means it's not specifically tailored to your personal financial situation. So if there's anything that you want to investigate further, always seek out the opinion from a qualified financial advisor to make sure that it's appropriate for you and for your financial situation. Also, my financial services guide is available to download from the description box below. So let's get into it. First of all, superannuation contributions, what are they? At its core, a super contribution is simply money that goes into your superannuation account. By the end, you'll understand concessional contributions, non-concessional contributions, salary sacrificing, government co-contributions, downsizer contributions, and a few other strategies that may apply to you. Some contributions are made for you, like your employer's compulsory superannuation guarantee, and others you can make yourself to boost your retirement savings. The key thing to understand is that your contributions fall into two main categories. Concessional contributions is the first one, and that's money that goes in before tax. The second one is non-concessional contributions. That's money that goes in after tax. Okay, let's start with concessional contributions. These are made with money that hasn't been taxed at your marginal tax rate yet. So instead, it gets taxed at just 15% inside your super fund, which is usually lower than your normal income tax rate. Examples include employer contributions like the superannuation guarantee. These are compulsory payments that your employer makes, and from the 1st of July 2025, this is 12% of your ordinary earnings. The second one is salary sacrificing. This is where you ask your employer to put some of your pre-tax salary into your super instead of paying it to you as income. For example, if you're earning $80,000 a year, your marginal tax rate might be 30% plus the 2% Medicare levy, and by salary sacrificing that money into super, money is taxed at 15% instead of the 30% plus the Medicare levy. And that's a big tax saving. More money is working for you in retirement. Remember, you don't have access to the salary sacrifice money until you're qualified in the future to access your super fund. Personal contributions that you claim as a tax deduction. So if you can't set up a salary sacrifice arrangement, you can still put money in yourself using your after-tax income, but you could also claim a tax deduction. One thing to note, check if your employer pays costs on your behalf to your super fund, such as administration fees and insurance premiums. These amounts are included in your concessional contributions cap. So why does this matter? Just remember there is a cap, so currently it's $30,000 per year for concessional contributions, including what your employer pays. So go over the cap and extra tax applies, so it's important to know the limits before contributing. You can keep track of all your concessional contributions by using the ATO online services. Select Super, then Information, then Concessional Contributions. Be careful with the time lags in information and cross-reference what's on MyGov with your super fund. And if you're a member of an unfunded defined benefit or constitutionally protected fund, be aware of how concessional contributions to these funds are treated. Making concessional contributions correctly can be tricky, so it's imperative that you seek advice from a financial advisor or from your super fund to avoid penalties. Next is non-concessional contributions. These are made with money that you've already paid tax on. For instance, moving some of your savings into super. There are no tax deductions for you with this one. Also, because you've already paid tax on that money, no extra tax is charged when it goes in. But once it's in super, your earnings are generally taxed at only 15% instead of your marginal tax rate, which is still a benefit. Now, there's two main types. So the first one is the personal after-tax contribution. These are payments that you make from your bank account directly into your super fund without claiming a tax deduction. They can be regular or one-off lump sums. The second one is a spouse contribution. So you can contribute into your spouse's super. And if their income is low, you may be eligible for a tax offset up to $540. The annual cap here in non-concessionals is $120,000 per year, but you can bring forward up to 3 years' worth and contribute $360,000 in 1 year if you're eligible. This is called triggering a bring forward arrangement, which lets you contribute up to 3 years' worth of non-concessional contributions in a single year. It allows you to make extra non-concessional contributions without having to pay extra tax. Eligibility for the bring forward arrangement depends upon your age, your total super balance, and you must not have already triggered a bring forward arrangement in a previous year and be in what the ATO terms an active bring forward period. Important to note to make sure you don't accidentally trigger a bring forward arrangement. You need to take into account all of your non-concessional contributions made to all of your super funds. You can keep track of your non-concessional contributions by using the ATO online services. Select super, then information, then non-concessional contributions. Be careful of time lags in information and cross-reference what's on MyGov with your super fund. Again, it's a complicated area and it's really easy to make mistakes. There are different financial consequences depending upon what type of contribution you make. And not complying may mean that you get a tax bill and then have to deal with the tax office to fix it. Consult an advisor or your super fund if you're not sure. There's also some extra contribution strategies. One of these is called the government co-contribution. If you're a lower income earner, the government may pay up to $500 when you make personal after-tax contribution. It's literally free money into your super if you qualify. Another one is a Downsizer contribution. So if you're 55 years or older and you sell your principal place of residence, you may be able to put up to $300,000 per person into super from the sale proceeds outside of the normal contribution limits. And for couples, this can mean up to $600,000. So this can be a powerful way to boost retirement savings later in life. And beyond these, there are other ways to contribute to superannuation depending upon your circumstances. These can include contribution splitting, and this is where you transfer some of your concessional contributions into your spouse's account. There's also catch-up contributions. So if you haven't used your full concessional cap within the last 5 years, you may be able to catch up now. Your total super balance is really important with this one. Each of these strategies has different eligibility rules, tax impacts, and long-term benefits. That's why it's really important to seek advice from an advisor or your super fund by making any type of additional contributions so you can avoid paying extra tax and make sure you've got the right strategy working for you. Inside super, remember, money is taxed at just 15% compared to your marginal tax rate outside of super, which could be anywhere from 16% up to 45%. So that means more of your money stays invested and compounds towards your retirement. So the trade-off, you generally can't access your super until you reach age 60 and can satisfy a conditional release. So it's a long-term strategy. Timing of contributions is important. Keep track of your non-concessional contributions and when they were received by your super fund. Contributions count towards a cap in the year that your super fund receives them. Make sure your fund receives all of your contributions by 30th of June if that's what you intend. If someone else, such as a financial advisor, accountant, or your employer, makes contributions on your behalf, check that they make the contributions in time to be received by your fund by the end of the financial year, if that's what you intend. If you make contributions by BPay, internet transfer, or similar, at the end of the financial year, check the terms and conditions of your financial institution and allow for any possible delays. Check if your contributions are held in another account or by another institution before they're received by your fund, as this can cause delays. And if the law requires a prescribed form to be provided before or when the contribution is made, then make sure your super fund has received it in time. So to recap, concessional contributions are before tax and are taxed at just 15%. Non-concessional contributions are after tax, but still let you move more savings into the superannuation environment. Salary sacrifice, co-contributions, downsizer contributions, and other strategies like spouse contributions, splitting, and catch-up rules could all make a really big difference. So the bottom line is, super contributions aren't just about retirement. They help you grow your savings in a more tax-effective environment. So in summary, superannuation is a highly tax-effective way to build your retirement savings. But it can be tricky, especially as the rules are often changing. Before making extra contributions, it's important to know the type of contribution you are making, review the contribution caps, and know exactly what the eligibility rules are and how they apply to you. Always get advice from a licensed financial advisor or call your super fund to make sure the strategy fits your circumstances. If you found this helpful, don't forget to like and subscribe for more financial tips, and let me know in the comments section what topic you'd like me to cover next. Thanks for joining me, and I'll see you in the next one.